Hello everybody, McGee Wolf with the Wolf Group, back again with another week of craziness in the world of mortgage interest rates. I want to first of all thank everybody for all the great feedback y'all have given me over the past few weeks in my effort to help people digest what has been going on in our mortgage interest rate world. It's been unprecedented. I know we've all been hearing that word so much as it relates to so many different things, but it definitely applies to the mortgage interest rate world. It is an unprecedented environment that we're in. So today is Saturday, March 28th, and my goal today is to just give you another level of insight as to what's been going on. It seems to be getting a little bit better, but it's still definitely crazy. Trying to help you get prepared if you're in the market to purchase a home or refinance your home, or your clients need a little insight. This is what this is for. So let's take a look at this graph again and help you understand what happened in this past week. Okay, so looking at the graph again. Now, I'm not going to explain everything I've explained in the previous two updates. So if you need a little more background, which you probably do if you're watching this for the first time, you should go back and watch my other two videos explaining some of the fundamentals of what you're looking at. But to pick up where we left off, here was where we ended up on Friday of last week, on March 20th. Huge day, recovered a lot of the losses, and then here's Monday, another strong day. Look at the movements in a day. That trend is continuing. Look where the normal movements are back in here. Just that's all normal. Right there, there's a big day. Big day here. But compared to these, those are small days. Here is Tuesday. Wednesday, we retracted a little bit. Thursday was a big day. Friday, we ended up 104 basis points on Friday. That was a huge day. So are rates reflective of where this market shows us where we should be? And the answer is absolutely not, for a lot of the reasons that I mentioned before on the previous videos. But the investors are holding back here. They're on the conventional loans. They've loosened up the rates a little bit, but definitely not on the government loans. They are not. There's really not an appetite in this market for higher risk loans, which most government loans are. They're high loan to value, low credit score loans. There's definitely a flight to quality right now in our marketplace. So here, that's just a glimpse. All indications are this is great news, but there's other news that's not so great that's holding interest rates back from getting back down into the mid to lower 3% range. So that's that. All right, so how does all of this data on these graphs in the Treasury bond market, how does that translate into what is happening actually with interest rates for you or your clients? Well, first of all, there is a flight to quality. And what that means is that government loans, especially FHA loans, are going to they're just not going to be as responsive to this interest rate environment as we would hope. There is not a great appetite for people that have credit scores below 640. They're going to have to be bringing money to the table in the form of discount points in most cases. So if your personal credit score is below 640 or in the 660 range, I encourage you to get prepared, start planning. Give us a call. We're good at helping people get their credit scores up. But there is definitely a flight to quality. Conventional loans have begun to loosen a little bit with the rates. We were able to lock some people, in the mid threes the other day, and that's great. But it's not where we think it's going to be. The general consensus is among all of the experts that I'm following is that they are expecting the mortgage rates to begin to loosen and more reflect all those green candlesticks that you saw behind me. Now, here's something important to understand. Generally speaking, mortgage interest rates are about 3% higher than the Fed funds rate. If you watch one of my earlier videos, I explain what the Fed funds rate is, which is basically what big banks lend to each other for a very short period of time. So if you're getting a 30-year fixed rate mortgage at 3%, I had some clients that was able to lock at 2.875 about a week and a half ago. There was a little opening in the market. We took it. They had to pay a little bit of a discount point to get it, but it certainly made a lot of sense for them. But I think that's about as low as interest rates would ever go. So if you're in the zone of getting a rate between 3 and 4%, that's really good. That's really good, and you ought to be excited about that. But we have a very fluid environment right now. Fannie and Freddie are giving us revised guidelines and direction. Often right now, we're expecting more information to come out from them because it is a dynamic and unprecedented time for sure. But we're having to look at loans much more closely. Our underwriting staff is being very scrutinous and making sure that people are in a solid and stable position with their employment. So make sure you keep your job, keep everything as it has been, and don't lose any hours. Again, my advice, like last week, is if you are in the market for a mortgage, be sure you're using a mortgage professional. Like I said, not just because somebody's wearing a white lab coat doesn't mean they can do heart surgery on you, right? So you need a mortgage professional to help you navigate through this. Now, finally, what I wanted to tell you is you need to be patient. You may want to join the list of clients that I have and our staff has. It's longer than my leg, of all these people that have all their stuff into us now, and they're waiting for the market to turn. And we have all their documents, we got their application, and we are just watching the market for all those clients. And then when the market moves, we're going to be able to lock them in at criteria that meet their goal structure. And I encourage you to do the same thing. And don't be in a hurry. This is a time to be prudent. So get all your documents in now, and hopefully interest rates will loosen up here in the next week to 2 weeks. And let's really hope and pray that the government loans, FHA, VA, USDA, begin to have interest rates that start to reflect the market as well. But those are going to be slow to come back. You may have heard people refer to loans called non-QM loans, which are higher risk loans with common sense underwriting. That entire market has shut down, at least temporarily. There is zero appetite for that. So get your affairs straight, get your credit scores up, and we would love to help you navigate through this crazy, unprecedented time. Y'all take care. Have a great day.